Hi, everyone, and welcome to today's webinar. My name is Anna, and I'm with the New Mexico Small Business Development Center. Today, we have Amanda Davis joining us, who is a certified SCORE mentor and is the founder and owner of a business consulting firm here in New Mexico. Amanda has guided many small businesses, creative professionals, and nonprofit organizations towards financial clarity and will be presenting basic bookkeeping. We will be using the Q&A function to take questions and welcome attendee participation, so don't hesitate to ask us any questions you may have. Amanda, if you wouldn't mind progressing to the next slide, that would be awesome. Thank you so much. We'll answer those questions at the end of the webinar and be sure to put those into the Q&A function. And then if you could progress to the next slide, which covers some COVID-19 business resource links. I won't go over these in detail, as we'll send you a copy of the presentation at the end of the webinar. And then the last slide on my end here is a reminder to please visit our website at nmsbdc.org to view our upcoming no-cost webinars, or to sign up for our no-cost counseling services. I will also send a follow-up email to you with this information. Tomorrow, we have 3 webinars going on: a tax strategies webinar at 12:30, a 2 o'clock negotiation skills for women-owned small businesses, and a 3:30 putting your business idea into practice webinar. So be sure to check out our website. Thanks so much for joining us. And without further ado, I'll hand it over to you. Thanks so much, Amanda.
You're welcome. And I apologize. I've got little dogs and they have a strict hear something, say something policy. So they might be chiming in, but we'll jump into the overview of today's presentation. We will talk about introducing you to bookkeeping and the difference between the accounting principles and bookkeeping practices. Why would you do bookkeeping and financial statements, and along the lines of that, also ratios. If this is the first time you're hearing about some of this, the statements you're probably somewhat familiar with or have heard before. Ratios, a lot of investors and creditors, people who will lend you money, will tend to look at these, and businesses who tend to want to improve and grow and do better we'll use these ratios as a form of metrics, as a way to say, okay, here's where we are, here's where we want to be. So that's why those things are important. We'll go to the training objectives. And basically, I'm hoping at the end of this course, or this webinar, you're going to understand the process and the purpose of bookkeeping, why it's important. You're going to understand the terminology. Basic financial statements, we simply just don't have time in an hour session to go through everything. I've got a 4-year degree from the University of New Mexico, and I can tell you there's a lot of work in and around financial statements. So there's so much stuff. We're just going to show you the stuff you need to know to begin, and then you can explore from there, and the basic financial ratios that we kind of talked about. And to give you an outline of what's coming up, what is bookkeeping, the top mistakes to avoid, terminology, the reports, and reports you can think of as statements. Reports and statements work together. If I say it's a report, it's also could be interchanged as a statement, and the ratios. And I'm going to prompt you to get out whatever note-keeping system you like. If it's pen and paper, if you want to have a Word document or something like that, go ahead, but we're jumping in. So get your pen and pencils ready. All right, what is bookkeeping? I know you're on the edge of your seats. Fun story, modern bookkeeping was formally established in the late 15th century by a mathematician and a monk. And that makes a lot of sense to me. A mathematician and a monk made this. And they talked about it in a book. And what they talked about was the double entry system. We're going to get into that. That's a term you're going to hear in repetition throughout this, this programming is double entry bookkeeping. And that means that bookkeeping is over 500 years old. Just think about that. How important is something that it's been around that long? 500 years. And so what you do to keep your books hasn't changed a whole heck of a lot, but how you do it has. And the reason it's changed in these 500 years, as you can probably guess, is technology. There are things that technology has done that has made these manual tasks that have been tedious and time consuming. The technology has really improved how that has happened and taken a lot of that time off. There are things like the OCR, the optical character recognition, that can take a scan of a text and read it and do something with it. The accounting software can take stuff from your bank account and import it. And then you can go ahead and work with that data from there. The software also, accounting software also has rules that you say, hey, when you see this, this is what you do with it. And they also have a way where you can have a digital imaging where you can capture your receipts. You know, everybody would have all of these paper receipts, and they would have to have a paper filing system, and then they would have to go through and manage it, and year after year close it out, this, that, and the other thing. Technology has made it to the point where you can do all of those things, but in a virtual and a digital world. So that's pretty interesting. Now, you've heard the term, I'm sure, accounting, and you've heard the term bookkeeping. And what the heck is the difference? Because they're almost interchangeable, right? Like you hear it said one way and the other way. So what is bookkeeping? Bookkeeping tends to be record keeping and data management. So when we talk about records and documents, the retention period, where you've heard, I'm sure, 3 years and 7 years and permanent. So 3 years is general correspondence, employment applications, internal audit reports, these types of things that you may want to record. I don't know how updated this is, but there's a general rule of thumb. 3 years is probably the minimum of what you're going to keep general things. 7 years, bank statements, canceled checks. I read this and had a little chuckle today. Canceled checks is almost becoming obsolete, but if you have a physical check that you give to somebody and they cash it, your bank would then cancel that check so it doesn't get used again, and then send you a copy of it. Now, most banks charge you for that service, even though they have to do the process anyway. But if you physically write checks, you have canceled checks, basically checks that have been cashed or processed. Contracts, leases, expense reports, invoices that you send to your customers, bills that your vendors send to you, any kind of personal records. An example of that might be a timesheet, sales records, those kind of things. And stuff that you never, ever, ever, under any circumstance, want to get rid of is tax returns and the documents that you use to create those tax returns. And you hear the 3-year rule or the 7-year rule, and you're like, well, why are tax returns permanent? I thought I only had to keep 3 years of those. And the answer is, if the IRS ever comes knocking at your door and asking you for something that's 10 years old, if you don't have that in your records to produce, then what's going to happen is you get to rely on what the IRS says they have. And that's a scary proposition. You want to make sure you are completely in control and have as much records on your end as possible, so that you can go ahead and have a good conversation without being told how it's going to go. And another thing that a bookkeeper does is they create, again, with these documents and records and data, they maintain these books, the bookkeeping, that is accurate and reconciled. What an accountant does is take those records, right? And then they use that data to summarize the business's financial position. And that's a lot of words saying, how good are you? How much loans could you get? Do you have more assets, more money that you can gather than money that you owe people, that kind of thing. It's kind of like a credit report. How good on paper do you look? And an accountant can help you with that. They can give you financial advice. we see this, we think you should do this, or you can go ahead and do that, and that outcome's going to happen. They can use it to prepare your tax returns. They can create certified financial statements. So let's say you wanted to buy something and your lender wants to make sure that somebody else has looked at these books other than the person putting them together. An accountant could say, okay, yeah, we looked at these and we're certifying these as the financials as accurate. And then another step further is an audit where they actually go and test the data and make sure the data is reliable. A lot of people hear the term audit and they think, oh, well, if you are audited and the report is good, then the financials are good and I'm in good financial health and yay me. But all really an audit does, it's kind of funny, is an audit says if the books say your financials suck, then you can rely on that because they suck. Or if the books say your financials are good, then you can rely on that because they are good. We've looked at the data, we've tested things. So an audit would come into play sometimes if you're getting money from the federal government, sometimes if you're borrowing big numbers of loans, sometimes if you're going to go and be publicly traded, typically that would require an audit. Sometimes nonprofits have to get audited. There's a bunch of different reasons. So an accountant would basically take what a bookkeeper provides and then go that extra step is kind of the idea. Okay, common bookkeeping tasks is doing the entries. Office management work, which is recording the billing your customers, paying vendors, processing payroll. They can do end of period closing, means they reconcile your accounts to the bank. They do any kind of journal entries if there's any adjustments that need to be made. They're going to look at your financial statements, make sure they look good and everything is in the right place. You haven't left anything out. You haven't duplicated anything, and there's not any major errors that they can find. And once they go through all of that work, you better believe they're going to lock your books, meaning you can't change them afterwards. So the last thing you want to do is go wash your car and wax it and then go drive it through a snowstorm because you just undid all that work. So locking your books is parking it in the garage, kind of. Internal management reports. So when we talk about the reports that we're going to be working on is the balance sheet, the income statement, the cash flow statements, accounts receivable, and accounts payable aging reports. And so these types of reports you can use to get loans and go to your bank and this, that, and the other thing. But typically what you're going to use these reports for is to manage your business. You're going to see how things are happening and progressing, and you use these reports to make good decisions to keep your company in business. So we'll move on to the next slide here, which is the top mistakes to avoid. I love this slide. It reminds me of Home Alone, right? That kid. The SBA, they have a statistic that half of new businesses fail within 5 years. And why do they fail? It's because they have poor financial management. If you're paying attention, doing proper bookkeeping, and you're actually looking at the reports, you can avoid a lot of these pitfalls that happens to small businesses where you spent money and it didn't make you money, or however the story may go. There's lots of different reasons. There's other things that we can talk about. There's different ways that you can account for things. If you account for them wrong, that could be a problem. One of the biggest mistakes is not separating your business and your personal, right? If your business stuff is in the same place as your personal stuff, then number one, your bookkeeper is going to hate you because that's just a nightmare to account for. Oh, well, I went to Smith's and that was groceries, but this Smith bill, I mean, I actually bought some, birthday cards for my clients. So that's business, and so if you do everything in one place, it creates a big headache when it comes to keeping track of everything. But more importantly, it actually creates what is a liability, meaning if something went wrong, when you're in business, you're doing something, and your client sues you. Well, you have insurance and other things, right, that kind of help mitigate that. But if it goes really wrong and it goes to court and you're talking big dollars that you could owe, if you put personal and business together and they can prove that, they can say this business is not separate from the individual. And what they can do is say, because they're treating the business like their personal bank account, then everything you own personally is free game here. Meaning they can take your house, they can take your car, they can take the clothes off your back if it goes sideways. So separate bank account, separate credit card account, separate PayPal account, separate Amazon account, separate everything. If you choose to use Venmo for your business, please reconsider doing that. I do not like Venmo as a bookkeeper. But if you use Venmo, you need to have a separate one for when you pay something personal, when you pay something for business. It needs to all be separated, completely in the line, black and white, no intermingling. If you make a mistake, you pull out the wrong card, that's fine, but you need to be very careful to try to separate that as best as possible. All right, not reconciling if stuff is going in at the bank and then you're not paying attention. I had a client who they weren't going into their books and looking, and somebody went on their website and created fake sales. Why would somebody create a fake sale? It's simply malicious. It's like somebody keying your car. They don't get anything out of it because they don't receive the money, but you get charged real fees to process those credit card charges. So these fake dollars that they pretended to spend with you had real costs. And because my client wasn't reconciling and looking at his books, he didn't know until I told him what happened. So having that real-time information controls. I had a company where they had physical checks, and somebody went into where the checks were because they weren't locked up, and they were able to pull out checks and write checks, and the bank cleared them. I've had people where they were supposed to receive a check and somebody intercepted that payment, that check, and they endorsed the check Mickey Mouse, and the bank processed that check. Literally, money's coming to you, somebody takes it, signs it, I'm Mickey Mouse, give me the money, even though the check was not written to Mickey Mouse, clearly, and the bank processed it. So you can't rely on other people's systems and controls. You need to definitely make sure that you have your own ability to find things that happen and to mitigate access to these things. A lot of businesses, and it's just human nature. Accounting is kind of complicated, right? If you think your profit at the end of the day is how much money you have in the bank, a lot of businesses do that. That's not real. Sometimes you have money in the bank and you had a loss in terms of your profit and your loss, how much money how many sales you had versus how much expenses you had. And there are different ways that kind of works together. So what's in your bank is not your profit. And a lot of businesses do that. Do-it-yourself bookkeeping is one of the items I noted. I'm not going to say if you do it yourself, it's a mistake. I'm going to say if you do it yourself, you need to know what you're doing. Because if you do it yourself and you're not reconciling things, you're not looking at things, you're not double checking what's going on, things can get out of control. No record keeping, meaning, hey, 3 months ago, you had this expense that hit your account, and what was it? And you're like, well, I don't know. It could have been a vending machine. It could have been this, that, or the other thing, or it could be fraud. But without a receipt or some sort of way to go back and figure it out, you're kind of at a loss. So not having those records or that trail of breadcrumbs to really help you out, those are some types of things. So we're going to move on to terminology. This is where to get your notes out. So what's happening here is we have a lot of terminology, and this is not comprehensive. This is a good number of terms that you're going to eventually come across. And I'm going to go through these as quickly as I can, but there's a lot. So we're going to take questions at the end because there's so much stuff in here, and we might move through some of this quickly. So I do want to interact and make sure we answer everything. So I'm going to move as quickly as I can. The accounting equation it has to do with your balance sheet. And your balance sheet is comprised of assets, which is things that make you money. So we just talked about assets there. Liabilities, which is on here, things that cost you money, kind of like a credit card payment. And equity, which is the difference between the two, which is basically what's left over at the end of the day. And the accounting equation says every asset you have, which is things that can make you money, it could be your bank account, it could be people who you've invoiced but haven't paid you, things that will make you money. And then liabilities, your credit card payments, your PPP loan or your EIDL loan or whatever it is, maybe a line of credit, and you got to pay that money out. So assets is money, that things that make you money. Liabilities is things that you owe money. So assets minus liabilities, assets equals liabilities plus shareholders' equity. Shareholders' equity is what's left over. We're going to go back to that equation. So just because I'm kind of going over it real quick, don't panic. You're going to hear it again and see it again. Accrual and cash basis. The difference between accrual and cash basis, the best example I can give you is a credit card. So cash is, if you're going to record things based on cash basis, that means you paid it, it's the money left your account, and now you're recording it. So this is kind of a timing thing. This is when it's recorded. Accrual is you charged it on your credit card. So it's money you owe, but you haven't paid yet. So if it's accrual accounting, you record what's owed, but not paid when it's owed. If it's cash, you record that credit card charge when you pay the credit card. So accrual is you record the charge when you charged it. Cash is you record it when you pay it. So that's the big difference with that. Hopefully that's pretty clear. We talked about assets. Accounting period is the length of time it takes to complete an accounting cycle. Many times it's at the end of the month, it's the end of the quarter, it's the end of the year. So you need to understand what period of time you're looking at. So if you're looking at a profit and loss for the month, but you really need the data to compare over the last quarter of sales, because that was your big time period of sales, that's when things were great for you, then you need to know what you're looking at and make sure that everything's done. So the accounting period has everything to do with timing. Accounts receivable is you sold somebody a product or a service, and they owe you money because you delivered that product or service, but they haven't paid you yet. So you sent them an invoice and they owe you money. So that's money that's going to come in. Accounts payable is the opposite. It's a credit card. You have charged that card for that expense, but you haven't paid it yet. And accrual is very similar to accrual. It's like the credit card. Something happened, but you haven't paid it yet. It's owed or it's earned. It's money that you have, it's services or products you've delivered, or it's charges that you've charged on a card, but you haven't paid it. So you're recording the accrual under an accrual basis. So that's what that is. Balance sheet, we talked about that. That has your assets, your liabilities, and your equity. A balance sheet has, it continues to flow. So the numbers on the balance sheet are from inception, from when you started the business to everything that's happened till whatever the period is. So those numbers constantly evolve, change as things happen in the business. Cash flow, easy enough. Money coming in, money going out. And why? What did you spend the money on? So the cash flow kind of gives you that kind of idea of what's happening there. Chart of accounts. Basically, it's all of the things that you categorize these transactions. So let's say you took a client out to a nice meal. The chart of account you record that meal to would be meals. right? You wouldn't record it to the restaurant. The restaurant's the business you paid. The place that you put that charge would be to a meal category. So chart of accounts is kind of a category so that you can actually summarize, okay, these are all things I paid for meals. Then at the end of the period, you can see how much you spent in meals total, not just to each one individually. So that's where the chart of accounts comes in. Cost of goods sold is basically if you're selling a product, that's typically the best description. Let's say you're selling t-shirts. A cost of goods sold is when you buy the t-shirts or make the t-shirts. And so you're either buying fabric or you're buying these t-shirts at a lower rate than what you would sell them for. So it's a wholesale rate. And so whenever you buy the t-shirts to sell, the idea is you wouldn't have bought those t-shirts unless you were selling them. So the only reason you have that expense is because of the sale associated with that expense. So a cost of good is something that's directly relatable to a sale. Double entry bookkeeping, we kind of talked about that. And so what double entry bookkeeping, when we go back to the history of this, bookkeeping had what's called physical books with paper that you would write in. And you have a ledger and you have a journal. And in the journal, you would record the individual transaction. And in the ledger, you would record the total of that journal. And so everything has to go in two places. And so with double entry bookkeeping, you have to do it 2 times. You're not recording the same thing twice. You're recording the same thing in 2 areas. And the way you do that is with debits and credits. So if a debit increases something, a credit probably reduces it. So if you have a bank account and you debit it, you're increasing the bank account balance. If you credit it, it's money that goes out of the bank and it reduces it. So if a debit increases it, a credit decreases it. That's typically what it is. And to record one thing, you need it, both a debit and a credit. You can't have one or the other. It has to have both. They come in a pair. Depreciation has everything to do with a large purchase. So let's say you bought an $80,000 vehicle for your company. And an $80,000 vehicle is all nice and good, but you can't say, I bought something for $80,000 and I'm going to write that off. I'm going to reduce my taxes and this, that, and the other thing. That $80,000 is useful for longer than when you purchased it, right? It's not in that moment. So they're going to say a car, and every type of thing that you buy has different rules. If it's a computer, it has a different life than a car, than a building, so on and so forth. So if it's something really big, then you have to go and say, well, how long do I have to take that cost and apply it over? So that $80,000, for example, for a car, you bought a car, you need to divide that $80,000 over a 5-year period. And there's different ways to do depreciation. We can probably spend a 4-hour class just on depreciation alone. All you need to know is it's a big purchase that you have to take the deduction over time, the expense. And so you allocate that $80,000 over years, several years. So that's what depreciation is. Equity and capital, we've been talking about that, right? That's what's left over. That's basically your value of the business at the end of the day without getting an independent evaluation. That's what happens with, okay, here's how much money is owed to me. Here's how much money I am owed. And the difference is what remains in the company afterwards. That is your equity and capital. An expense you're probably pretty familiar with. You bought something. You bought paper. You bought a meal. You bought a desk. You bought, maybe it's a small desk. Maybe it's IKEA. Maybe it was only $80. It wasn't, a big desk that cost, a lot of money. So an expense is something that you paid for the business, and you get to deduct it in the period you paid for because it's a smaller amount. The fixed asset, we touched upon that with the depreciation, right? So if it's a big thing like a building, like a car, like a large equipment, let's say You bought a computer and the computer cost you $5,000. Well, a $5,000 computer, because I don't know, maybe you do a lot of graphics video, it costs that much for the computer. And so because of that, because it's a larger purchase, that $5,000 needs to be taken over time. And that's what depreciation is. And there's different rules. We've heard of, you can deduct things using section 179 and bonus depreciation. Like I said, we can spend 4 hours on depreciation. Just know the idea of depreciation is taking a big purchase and, applying it over time. Okay, fixed expense. So fixed expense kind of works like with variable expenses. So when you have things that you pay for, some things are paid for by how much you use them, and some things you pay that same amount regardless. So a fixed expense, a really good example is a mortgage or a lease, a rent, right? Because it doesn't matter how much time you spent in the place. It doesn't matter. Nothing matters. It just matters that this is what you agreed upon, and this is the amount you're paying, and it really doesn't matter. If you have a storage unit, it's the same amount every month. It doesn't matter whether you have something in that storage unit. You're a gym membership, which likely is not a business expense, but whether you go to the gym or not, you're still paying that $20 a month. That's a fixed expense. A variable expense is like utilities. So in the summer months, your electric bill tends to go up because you're cooling your house, and that creates you're generating more electricity that you're using, and so you're charged more because you use more. And in the winter months, typically that would go down on the electric side. If you have like a gas furnace or whatever, maybe it costs less. In my personal case, that's what it is. And so because it costs less and I'm using less, I'm going to pay less. So my mortgage doesn't change, but my utility bills do. So fixed means it doesn't change. Variable means it changed with use. Okay. General ledger, we've kind of talked about that, where we have the journal, which I also like to call a subledger, and we have the general ledger. So you have the one place where you record all the little details, and then you have the general ledger that records everything but the total numbers. That's what the general ledger, that is all of your chart of accounts for all of your statements, and everything is in there with the total numbers. We talked about the journal. The journal is, okay, well, you said that I had $80,000 in a car, in cars and assets. Is that one car? Is that 4 cars? What does that $80,000 make up? The general ledger will tell you have $80,000. The journal will tell you whether you have 1 car or 4. That's the difference. The journal's a detail. Liabilities is things you owe, like a credit card. Income and revenue, that's things that you sold. If you have commissions, if you have service, if you have products, it could be anything. So this is money that you have earned from selling things that you're in business to do. Payroll, I think, is pretty straightforward. If you have employees and you pay them as part of helping you run your business, that is what payroll. So that includes wages, the salary, and it includes payroll taxes, things like federal income taxes, state income taxes, Social Security, Medicare, unemployment, all of those things. You may consider payroll to have employee benefits as part of it. If you're supplying health insurance, that kind of stuff. It really depends on how you want to categorize it, but that's payroll. Profit is basically you sold things and you got money for it, and then you bought things to operate. And at the end of the day, the difference between the money that came in from selling stuff and the money that went out from buying stuff is your profit. Again, your profit is not what is in your bank account. Your profit is calculated differently. Reconciliation is saying, hey, I recorded all this stuff in my books, and then the bank says, this is what happened over here. And then you look at the two and say, do these things agree to each other or not? And if they don't, you need to find out why, and you need to resolve it. So basically it's reconciling. When you say your bank account balance is this number at the end of the day, and your bank says this is your bank account number at the end of the day, maybe it's the end of the month, then you need to go and say, okay, everything that went through the bank actually is recorded over here. And it's a way to kind of double check. The subledger, we kind of talked about that. It's like the journal. That's the detail behind the general ledger numbers. So you have a total number of fixed assets. The subledger will tell you how many and what you paid for each. The trial balance will take everything from your general ledger and they will make adjustments like depreciation or anything else that needs to be fixed, corrected, updated. And your trial balance at the end of the day is your general ledger, but adjusted to be the right numbers. And then you go and use that trial balance to create your balance sheet, your income statement, all these other reports. And the variable expenses, we did speak about, the more you use, the more you pay, and vice versa. Terminology to know. These things, I just want you to make sure that you've heard it at least once. And then the next time you hear it, you're going to be like, I've heard that. And then you go and look it up. And hopefully the more frequently you hear about these things, the more it'll trigger, oh yeah, it's this, it's that. I get what you're talking about. People won't be talking over you because that's really annoying. And accountants really like to do that to people. I don't know why. Moving on to financial reports. So we got a little bit of time here to kind of cover all of these things. We might be going a little bit fast, but I believe this PowerPoint will be shared with you attending. And so you can go back and look at it, but this gives you an idea of what we're going to look at going forward. So we have the balance sheet, which is comprised of assets, liabilities, and equity. We talked about that, things that make you money, things you owe money, and what remains. The aging reports. This is kind of new. This is a new concept we're bringing up here. Accounts receivable is you invoice your customer and they haven't paid you yet. That's an asset, right? Because that's something that makes you money. Accounts payable is things that you owe but haven't paid yet, very much like a credit card. And so these are pretty much your subledgers. So when you say, I have accounts receivable of $180,000, you then go to the subledger and say, what customers owe me what and for how long? Same thing with accounts payable. Go to the profit and loss. Revenue is sales. You sold a product, you sold a service, you got commission, something, you sold something and you made money. Cost of goods sold is if you sold them something and it cost you something to make that sale directly. You couldn't have made that sale, that candle, without buying the candle wax and the glass container it came in and so on and so forth. That cost was directly associated with that sale. That's your cost of goods sold. And your expenses is everything else. Your bookkeeper, your rent, your utilities, so on and so forth. And then we move on to cash flow, because cash flow is almost basically saying what happened here and what happened here. So it takes your balance sheet and your profit and loss and it kind of reconciles it, is really what's happening. And so it says, hey, you had money go in and you had money go out. Where did the money go and what was it used for? Or where did the money come from and what was the purpose? And so that's what the statement of cash flows is. So we'll just jump on into my little graphic over here. So a balance sheet. And a balance sheet doesn't look like these blocks of text and color. But I found this super helpful. We talked about that accounting equation where the total assets equals the total liabilities plus shareholders' equity. This kind of visually gives you that. Total assets fills up this whole side. And then the other side is divided by liabilities and shareholders' equity. These all have to be the same at the end of the day. The total assets have to equal liabilities and shareholders' equity. Assets are things that make you money. Liabilities are things you owe money. Equity is what is left over. Assets are things like a bank account. Accounts receivable, you invoice your customer, they haven't paid you. You bought a vehicle. You could sell that vehicle if you needed to, and it would make you money. Other current assets are things that would also bring you in money. Current in this case means 12 months. Anything less than a year would fall under the current category. Anything longer than a year, something that is something that could make you money, but let's say it's a money market account. You have money in a money market account and you can't sell that money market or take your money out of it for 5 years. That's the term. Otherwise there's penalties or whatever. A current asset is a savings account, right? Because you can pull the money out anytime you want. A long-term asset, right, would be that money market because you have 5 years before you can do anything with that money. That's the difference. Accounts payable would be somebody sent you a bill, but you haven't paid it. Credit card, a line of credit from the bank, somebody gave you a loan. And again, we're here current and long-term. So current means you have to pay that bill within 12 months. Credit card is current. I don't know any credit card company that's going to be cool with you paying them, 12 months after the fact. You are going to pay them monthly. A line of credit typically revolves in a year cycle, so that's probably a current liability. A long-term loan would be like your idle loan, right? If you got COVID funding for the economic injury loan, the idle loan would be something that is collected over a 30-year term. So that would absolutely meet the long-term requirements. So it would live under that area. And then equity is what remains. And equity, there's a lot of terms that live here. So if you're a corporation, you have stock and you have paid in capital and you have retained earnings. You could have members equity. You could have owner draw, owner investment. There's lots of terms that live here, but basically this is what remains after things that make you money and things you paid money. This is what is left. So I like to break down the balance sheet. Typically, you would see it all in one document, right? Where you would have the assets, liabilities, and equity. It's a big, long document. So I wanted to break it out to kind of give you guys, okay, we've talked about it. We've brought it up. There's been some things in repetition here. Now we're going to go look at an example. And so this is an example of T-ball bat and glove balance sheet for 2008. So we're real current on this example. And we have current assets. So current asset is cash. Cash you can take out of the bank. Accounts receivable. I surely hope you're not letting your customers pay you over multiple years. Inventory. Let's say you bought a lot of t-shirts because you got a good deal on a volume purchase, right? You ordered a lot of them, so they gave you a discount, but they haven't been sold yet. So they have to sit somewhere. This is something that makes you money. Inventory is something you sell. Well, you haven't sold it yet, so it's not sales. So it's sitting there as an asset of something you can sell. Plants and equipment, that can be your computer, that can be furniture, that can be all kinds of stuff. And the depreciation, like we talked about, you're going to see the depreciation that accumulates over time. That's why it's called accumulated depreciation. So this is the depreciation for the entire asset. So if it's $160, however long we've been depreciating that asset, the total depreciation for that asset is $100, right? And then the difference is the net fixed asset. So 60 minus 100 equals $60. The net fixed asset is what hasn't been depreciated, right? And then you have your total assets. This can look so different for so many different companies, but the general concept is the same. You have assets, both current and long-term. I'm going to move on to liabilities. Very similar to assets, where you have current and long-term things that you owe. A credit card, maybe P&M sent you a bill for your electric bill, but you haven't paid that bill yet because it's not due for a week or so. You have all these things, and long-term debt we kind of talked about. Long-term debt might be that idle loan that's due in 30 years, and the current loan might be your line of credit that's due in 8 months. Financial reports, we're looking at the balance sheet and we're looking at the equity. And like I said, equity can have all these things. What you're seeing here is for an S corporation or a corporation. It could be a C corporation or an S corporation. The corporation has paid in capital, they have retained earnings, they have treasury stock. If this was a partnership, you would have the different partners ownership in the business. So you would have it based off of the ownership. If this was a single member LLC, you might just have one owner with things like owner contribution and distributions. So there's different things in here, but at the end of the day, the equity section is what remains. You have things that make you money, things you owe money, and the difference is what's left over. And then we come back to the equation. If I haven't beaten this horse to death, this is a physical representation of everything that makes you money should equal exactly what you owe and what remains. These are the accounts receivable and accounts payable, and I thought I'd put a fun little graphic. If an invoice is due in 30 days and we pay it in 60, if it's due in 60 days, we pay it in 90. If it's due in 90, they probably don't need the money anyway, which is, dry bookkeeping humor. I hope you find that funny. So accounts receivable and accounts payable. We talked about money owed to you, money you owe. I think we've driven these points home. What you want to know about these two things, what's important to you, what's going to really make your business do well, is accounts receivable is the rabbit, the hare, the tortoise and the hare, And so the accounts receivable is the fast thing. You want to collect your money as soon as possible. You want to get that money in the door as quickly as you can. So that's the rabbit. You want to run that race fast. Accounts payable is the turtle. It walks slow, it's slow going. So if you can pay things slower without penalties or without interest, if you can say, can I pay this in 60 days, but not incur any money to let you pay that far out, then yeah, you want to get money in the door as quickly as possible, and you want to reduce the amount of time that money goes out the door. And sometimes that doesn't always work. Sometimes if you pay late, there's late payment penalties, there's interest associated. That's not what we're talking about. We're not talking about incurring those interest and penalties because you want to pay it later. What you want to do is work out with your account. Your accounts receivable should be due upon receipt. Your accounts payable, you'd like to pay it in 30 days. That way, then the money comes in, you can cover these bills, and it just, the inflow is always coming in faster than the outflow. That's the whole point of this. Okay, we're moving on to profit and loss. So this is a pretty simple, straightforward thing. Revenue is your sales. Expenses is what you paid to do business, and your profit and loss is what's left over. If you have more revenue than you have expenses, you have a profit. If you have less revenue than you have expenses, you have a loss. A loss would be negative. Ideally, you don't have a loss because you're in business to make money. So hopefully that works. So revenue is sales, it's commissions, it's whatever you want to call it, but you did something in terms of your business to make money. And that's what the revenue is. The cost of goods sold, we beat this horse to death. It's things that you directly pay for in order to make the sale, like inventory. And if you have to order those t-shirts in and you have to pay shipping, then that is also a part of selling those products. Operating expenses, rent, advertising, payroll, your bookkeeper, your accountant, your attorney. And then we have this like other category, right? Other income and other expenses, meaning these are not things that are in the direct course of you doing business, but they still happen even though you're in business. So you have a savings account, right? And in that savings account, you make a really tiny, insulting amount of interest, and you have to record that interest somewhere. So it lives outside of sales because this is not what you do for the business. Interest is kind of a byproduct of just having this account. It's not what you're in business to do. If you were in business to make interest, you'd be a bank or a lending institution. So the interest happens outside of what you're doing to make money. So it lives in this other category, and penalties and settlements, different types of other non-operating expenses, basically. So things that aren't required to keep the doors open or to keep operations going. And then again, the difference, the total revenue, less cost of goods sold, less operating costs, plus other income, minus other expenses, equals what remains. So there you go. And here's an example of a profit and loss from 2018. So we got a little bit more current on this example. And so it tells you the total sales and it tells you the total cost of goods sold. And the difference is your gross profit. That's basically you bought $75,000 worth of things to get that $100,000. So what's left is that $25,000 over. And then the rest of it is operating and non-operating. So you have advertising, so on and so forth. You have sold an asset and you made some money, things of that nature. And then we move into the statement of cash flows. And this is about money came in, went out, and trying to figure out what happened to the money and how was the money spent or whatever. So operating activities, here's some examples. This statement of cash flows could be its own semester as a class. It's a really complicated statement. I'm just trying to get you guys introduced to it, and then you can go from there. There's two different methods of creating this statement. One is called direct method and one is called indirect method. It's one of the more complicated areas in terms of how to put this together. If you have an accounting software like QuickBooks, they're going to put this together for you and you may not understand why, but there's different buckets. And so when it comes to money coming in or coming out, you can say it's operating. And what's operating? When you sell something and you made money came in because you sold something, well, that's operating. Interest income in here, it's called operating. I know we just said that's not in the profit and loss, but things are different things mean different things in different reports. So I apologize for making that a little convoluted, but the cash flow statements, like I said, is a little complicated. Operating expenses, these are paying your bookkeeper, paying your rent, paying your legal team or whatever, or your payroll. Investing is you bought a piece of land. And so the money that left the bank account is because you invested in an asset. Accounts receivable money came in from billings that you received, right? Or money went out because you had to pay a credit card statement. Financing is loans, it's stock purchases, it's dividends, those kind of things. So we'll have an example here of the summary cash flow statement. So you can actually see, here's what happened, here's the net income, the depreciation, it breaks everything down and it goes in and out. And then it starts with the beginning cash and the ending cash. And this is in general what a cash flow statement does. And at the end, or what it looks like. And at the end of the day, money came in, went out, and you want to know, well, how much went to operating stuff, how much went to investing, so on and so forth. This gives you an idea of what that looks like. And the ratios. So there are a lot more ratios. These are the formulas on how to use these ratios. And again, we're going to share this PowerPoint with you, so I'm not going to spend a whole lot of time on this. But these are the different ratios: the break-even point, the current ratio, debt to equity ratio, the quick ratio, which is also the acid test, return on equity. I included the gross margin in here because that was a part of the break-even analysis, and then working capital. And these ratios can determine your financial health, kind of like your credit report. If you take these financial statements and apply these equations, it will tell you how good or bad you're doing financially. And that's the important piece of these. So I'm going to stop here. And Anna, I will let you come in with the questions, comments, so that we can finish up and hopefully address as many questions as we can.
Okay, sounds good. Yeah, thanks, Amanda. So yeah, we have a couple of questions. They're all in the Q&A. You can take a look at those as well if you want to look at them in more detail, but I'll go ahead and read them to you. The first question that I've got here is, what is the best way to pay ICs? Check sounded outdated. Thank you.
ICs. I'm not sure what an IC is being related to here. I apologize.
Okay, if you, Melora, I believe it was asked that question. If you wouldn't mind just typing that into the Q&A and we can get back to you. So in the meantime, I'll go ahead and get down to the next question here, which says, tell me again who locks the books. In my software, once I reconcile with bank statement, the history is locked.
Okay, well, that's a part of your accounting software. Typically, like if you use QuickBooks Online, who's ever recording and doing the bookkeeping would actually go in, and it's a different step where you would go in the settings and say the history is locked up to this date. Most softwares, when you reconcile, don't actually lock the history because typically there's more to do after you reconcile.
Okay, and then we have another question. Is there an online encyclopedia for accounting terms?
I would go to Google. I know that sounds kind of, silly, but Google has a lot of information on this. Investopia has a lot of information. A lot of the colleges has this information. The SBDC has resources for this information. SCORE has information, West, WESST. You can find this information in so many different places. So starting with Google might get you going. And again, you're going to have this PowerPoint so you can look up if you didn't have time to write down. I know we went through really fast, but you should be able to go back and look those up and see different definitions. So the one that resonates with you is the one that you'll remember.
And then we do have some clarification in regards to ICs. I didn't know what that meant either. Independent contractors. And then she said, sorry about that. So thanks for clarifying.
I imagine that was about the Venmo thing. So there's a balance. There's a lot of different ways that you can pay people. A check sounds outdated. Yeah. I would not pay people with a check because I hate paper and I like to be virtual and I like automation. Venmo is an option. There is, if your banking institution has it, there's Zelle, Z-E-L-L-E, I want to say. Zelle is an option. PayPal is an option. I use my payroll company called Gusto, like he ran with Gusto, G-U-S-T-O. I put my contractors in there. If you pay an independent contractor, you absolutely need to collect the form W-9. You can find that on Google as well. W-9. You need to collect that before you pay them because you probably will need to issue them a 1099. And asking them for that information after you've paid them is problematic. So I would get that 1099 form and I would work out with your contractors what's going to make the most sense. There's like a cost benefit analysis as to how you pay somebody versus how convenient or how easy or whether it makes sense. So there's a number of ways to pay them. I would work with your contractor. If there's a way to pay them electronically, that would be my vote.
Okay, and one last question. If my business is a service, do I have a cost of goods sold?
It depends. Typically, the answer to that is no. But things are a little bit more complicated, right, than that, as we all see in real life. For my business, I do bookkeeping for a living, right? I offer virtual bookkeeping coast to coast. And what happens is I've got a lot of software. So QuickBooks Online, I pay for my customers because I get a lower cost and I save them money and flow that cost through. So because I created a customer hired me to do their books, I'm not paying for their QuickBooks software unless they hire me. So that technically would be a direct cost of goods sold. So you can make an argument either way. But when it comes to like your taxes and how things work with loans and how much taxes you owe, a cost of goods sold does the same thing as an operating expense. It still comes and it reduces how much sales you had down to what your taxable income or how much your profit and loss is. So even if you have those in the wrong place, you're still going to receive the benefit. But yes, typically the answer is services don't always have cost of goods sold. Most of them don't, but some of them do.
All right, and I see one more question if you're willing to take it in the chat.
Of course.
And that is, how much do taxes affect paying independent contractors from PayPal or Zelle?
I don't think there's taxes associated with PayPal or Zelle. There might be merchant fees associated with that. I don't think there's any fees associated with Zelle. But when you pay a contractor, it doesn't matter how you pay them. The fact that you paid them, actually, you get to deduct that. So that would reduce however much you would owe in taxes at the end of the day. The only other way taxes would impact an independent contractor is if they should have been an employee. And if they should have been an employee, then you should be paying payroll taxes. And the employer pays a certain amount of payroll taxes, and then the employee pays a certain amount of payroll taxes, right? So I'm not sure if I answered that to fulfill what they were looking for, but if you pay a contractor, it reduces your income taxes from the business, your profit. It reduces your profit. And if you're paying them as an independent contractor, you're not paying payroll taxes.
Okay, excellent. Thank you so much for all that information, Amanda, and everyone for your attendance. We really appreciate it. And then lastly, just want to remind you that the NMSBDC is here to help you during any stage of your business. We offer these no-cost webinars and also our no-cost counseling services. So please don't hesitate to reach out to us. And it looks like you did have a next steps final comment slide here. So sorry if I interrupted that, Amanda, and if there's anything that you want to say.
I figured this was right timing for the next steps, right?
Excellent. So yeah, I'm pretty much done on my end as far as wrapping it up. We've got some thank yous coming at you. This was a nice refresher, and thank you for the answers to our questions. And then if you have some final words, we can wrap up with that, or we can just leave it as is.
Yeah, I think we may have one or two more slides here to cover. If you need any resources from the SBDC, here is their website, www.nmsbdc.org. And the final slide, which I adore because death is not the end, because you end up paying taxes after you die, which is a little bit morbid, but I thought it was kind of a funny little slide to end our show. So I do appreciate everybody taking the time for this webinar. And if you need anything, absolutely reach out to the SBDC.
Thank you so much. And again, lots of thank yous coming in. So thanks all around. And I will go ahead and dismiss the remaining attendees at this point. Thank you so much. We hope to see you again.